We have nominal coming in at, 6-7%. A 10-year rate of 4 does not strike me as being, high. So could we see rates stay here, go a little higher, as long as the economy is chugging along? Yeah, sure, why not? Unless inflation naturally goes down to 1, the curve's the wrong price and 10's the wrong price.
Harley Bassman, managing partner at Simplify Asset Management, also the Convexity Maven and the creator of the Move Index. It is so great to welcome you back on the show. Great to see you again, Harley. Thank you so much for taking the time.
Oh, thank you. It's fun, crisp, a clear day finally in California after the rains, so it's kind of nice.
I love it. Well, I really enjoyed our last conversation, which I think was October 2022. And so I'm thrilled to have you back. And Harley, I would like to start where I always start with my guest, and that is to get their big picture, macro view, their assessment of the economy and the markets. And while you share that framework, one thing is you can take all the time you need.
Thank you. The big picture view from where we are right now still is the market is ahead of the Fed by a lot. If you look at the derivatives market, the futures market, they were pricing in, basically 6 cuts this year in interest rates. After the Fed basically said in their dots, their projections, there'll only be 3. The market's still looking for 4 cuts. They know something we don't, perhaps. But that has really twisted the curve in a very strange way. Most people look at like 2s, 10s, or 3 months to the 10-year, things like that, about this prediction of a recession. The more interesting spread is actually the overnight rate, Fed funds rate, to the 2-year rate. That is really very negative. Negative by the actual number. The 2-year rate's way under. And the market is still saying that you're going to see the 1-year rate 110 basis points lower a year from now. I don't buy that. It's possible for sure, but I don't buy it. I don't buy it because I don't think we're going to have inflation coming down as hard and as quickly as people think. I've written about this extensively, but in a nutshell, it's just demographics. The boomers are retiring and taking their labor and their skills and productivity with them, and they're demanding goods because they have so much money from their stock holdings and bond holdings and real estate holdings. As I mentioned, the boomers have robbed the millennials because we vote, by the way. You guys don't. And thus there's this demand, and the supply of goods and labor is less because there's fewer millennials, and also we've choked off immigration, notwithstanding the border surge happening right now. We've reduced the illegal immigration in this country. So the supply of labor has been reduced, demand's still high, and therefore inflation ain't going to be coming down as much as the Fed would like. And this then feeds into this whole concept of why would the Fed cut rates or not? And my thought is, once again, this notion that the great tragedy of mankind has never changed in thousands of years. We wrote about the Greeks wrote about it. Shakespeare wrote about it. It's hubris. It's ego. I can not go into politics. You guys can connect the dots, I think, about ego here on both sides. And Jay Powell, he has an ego. What's wrong with that? I have an ego. I'm not shy. And Powell's not going to want to go down as Arthur Burns, who was the Fed chairman in the 70s, who, cut rates, took rates up, took them back down again too quickly, and all of a sudden we had inflation coming back, which led to the big inflation of the 70s and early 80s. Volcker, crushed inflation, and he's a hero. So Volcker is a saint, Burns is a dog. I kind of think that Powell at this stage of his career wants to have his tombstone saying, Volcker revisited. He slayed inflation. So he's going to really want to wait till he's really sure that inflation is kind of wooden stake in the heart dead. And that's not yet. And when you have unemployment at whatever it is, 3, 5, 6, 7, 8, under 4, that is not what you call, something that's going to go lead to tightening the market and suppressing inflation. So we're not there yet. I think he's going to want to wait till he sees the whites in their eyes for it to happen. So that's the big picture idea of what I think is that the Fed's going to cut 3 times as advertised, maybe, and it starts till July. And thus, the curve's kind of the wrong shape, and there are a number of securities in the market that are the wrong price.
Okay, this is fascinating, but real quick as a follow-on. So it sounds like inflation, it's still going to be here, driven by these demographic trends that you highlighted. Does that mean like the 2% target might not be realistic? Do you think the Fed might have to reset expectations for inflation? I'm curious what that could mean for their policy decisions when it comes to rates.
Look, the notion that the Fed cannot, 10 years ago, that the Fed cannot create inflation is bogus. They can create inflation all right. They can create 10, 20% inflation in Zimbabwe. The hard part is taking it from like a half and 1 up to 2, 2.5. And that's the hard part, is thread that needle. And similarly, right now with inflation at 3, 4, can they get to 2? Yeah, sure they can get to 2, but it's going to take a little work to do that. Do they want to go and do the work required? Probably not, because that would require taking unemployment up to 4 and change. So do they want to go do that in election year? Kind of doubt that. So they could probably just leave rates where they are. You really can't call rates restrictive, at least by the evidence we've seen, which is, GDP coming in at 3-4%, 5 and change last quarter. If you add in, let's call it 3 and inflation of 3, you're talking a nominal of 6. Nominal of 6 ain't, I wouldn't call that restrictive in any way at all. So can they get to 2? Yes. Do they want to get to 2? I think they'd like to. Will they tighten the screws enough to get to 2? Not in the short term. I think they're going to leave rates here, or think about slowly and kind of hope the economy kind of slides into it. I guess that's the soft landing notion, and it's looking pretty good right now.
Yeah. And going back to earlier when you were talking about the yield curve, a lot of folks look at like the inverted yield curve as a prediction of a recession. We actually had the yield curve, the creator of the inverted yield curve indicator, Professor Cam Harvey, on the show not too long ago, just a few weeks ago. You were talking about like the 2s and 10s, the 3s and 10s. Do you have an outlook as to like the economy? Do you see a recession? Your thoughts, and do you look at like that indicator as do you think that is indicative of a recession to come as well?
One could argue we already had the recession in 2022. We did have a couple of negative GDP, so maybe it already occurred. Look, we're going to have a recession at some point. Is it going to be in 2 months or 5 years? I don't know. So I guess at some point, people could raise their hands and say, yes, it was right. It really has not happened in the ordinary timing that one would expect, which is the 18-month area. I think the more interesting question is not, has the Fed taken the front end up too high, but why is the back end so low? There's probably factors going on away from the economy that are driving that. I suspect one of them being that when rates got to a certain level, you saw the big, long liability managers, the big pensions, the big insurance companies, the guys who owe money to someone 20, 30 years from now. That's their liability, right? Life insurance policy, pensions way out there. These guys have been in the hole for decades. And finally, when rates have gone up enough, they can go and buy, ultra long dated securities, 20, 30 securities, maybe some credit bonds in there also. And they can defease their situation entirely and make the problem go away. And after years and years of them being under invested, negative asset liability mix, they could kind of pair things off. That's not crazy. So it could be that people are just, that these long liability managers are buying long dated securities to go and make their problems go away, even if rates should be higher in theory. I mean, the old rules, big, old wide-tailed rules, was that the 10-year rate should be kind of somewhere kissing nominal GDP. There's, MBA reasons of why that should occur. It doesn't matter. we have nominal coming in at, 6-7%. A 10-year rate of 4 does not strike me as being, high. So could we see rates stay here, go a little higher, as long as the economy is chugging along? Yeah, sure, why not? Unless inflation naturally goes down to 1, the curve's the wrong price and 10's the wrong price.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. Okay, so in this environment, this backdrop, what is the trade? What is the trade that is most attractive to you or most interesting to you as it relates to maybe the Fed and when they might cut, if they will cut? What are the investments that you think will offer the best returns?
Well, look, let's break it into 2 pieces. You have equity risk and you have bond or fixed income risk. I deal in bond land. I don't deal in equities. So should you have 50, 60, 70, 80% of your money in some equity products? Yes. So take it off the table. I'm not going to say sell stocks and buy bonds. Now, you will have some amount of money in bond land for lots of reasons. Don't matter what the reasons are. You have some allocation there. Where should that money go? What I would say is right now, mortgage-backed securities should be taking on a much bigger proportion than you traditionally have had. Mortgage bonds are, I'm going to say crazy cheap, but I'll rephrase it. Just the wrong price. They're just the wrong price right now. And I think we have a chart that you're going to pull up eventually. And on this chart is two things. One, the pink line is the mortgage spread. So the spread of a mortgage bond over a 10-year rate. And the green line is the IG, investment grade, so triple B and better corporate bonds, which are trading around about 50, 52 basis points right now. And the mortgages are trading like 150, 160. So mortgage bonds are trading almost 100 basis points more than credit bonds. Mortgage bonds that cannot default. Theoretically, Fannie and Freddie are not full faith in credit. Ignore that. That's nonsense. Fannie and Freddie are full faith in credit of the U.S. government. They will not go down. If you think Fannie and Freddie might default, my advice is to, get a gun, cans of tuna, and small denomination gold coins because it'll be the end of civilization. It's not going to happen. Mortgage bonds, it's just very simply, they've taken Fannie Mae, Freddie Mac, Ginnie Mae, these government agencies. They collect tens of thousands of mortgage loans, put them into single securities, stamp them and guarantee them, put them out in the market, and they trade like water. It's the second biggest asset class of bonds after U.S. Treasuries, more than munis, more than corporates. No one ever sees these bonds because they're very hard to buy as a civilian. They're very hard for ordinary investors to buy them. Professionals, hedge funds, pensions, insurance, they're the huge buyer. Banks, they're the big buyers of these things. Civilians don't buy these things. That's why they're not familiar with them. We've invented a product that allows you to get these bonds. But we'll ignore the sales pitch for later. And they're trading, 100 over. This is what you should be buying. You should be over allocating to this sector of the market. The risk is this. When you are in bond land, you can take duration risk, credit risk, convexity risk. Those are the 3 buttons you can push. If you have cash, overnight money in treasuries, if you go away from that, duration risk is when do I get my money back? 1 year, 5 year, 10 years, 30 year. Credit risk, will I get it back? Will the company default or not? Convexity risk is how you get it back. And this is what mortgage bonds have. They have this convexity risk because you don't know when you'll get your money back. Because when you buy the mortgage bond, you're basically buying the underlying mortgage effectively. That homeowner can keep that loan out there for 30 years or prepay tomorrow. You just don't know. And that's the risk you have. This optionality is the risk you're short in a mortgage bond. And it's, it's a bother. Is it worth 100 over credit bonds? No, it's not worth that much. And that's why you should buy these things. So you're taking convexity risk as opposed to credit risk. You don't know if you get your money back in 2 or 3 years or 5 or 8 years. So I think it's the best trade out there. Bonds.
In bonds.
In bonds.
Why? And can you explain it in like a really simple way? Like I know, not like you said, not everyone is in bond land. It's mostly the professionals who are in it. But can you explain it for like that kind of lay person, like a really simple way? Yeah.
Okay. Most people are for those stocks. Many people are for what's called a covered call strategy. So you buy IBM at 100, you sell the 105 call against it for 3 points, and you're taking in there's 3 points of money. If IBM goes up above 105, you lose the stock. It's called from you. So you make 108, right? Because you took in the 3 points. That's the most you can make. IBM goes to 120, 130, 150, 500. You're stopped out at 105. And the downside, you own that stock 1 for 1, down to 90, 80, 70, 50. So but you've taken in 3 points of money, but you've shifted your payoff profile to where you have all the downside, at least some of the upside. A mortgage bond acts the same way. It's kind of like a covered call on a 10-year treasury. And the option you're selling is not a 1, 2, or 3 month option. It's like a 3-year option. Well, it's actually a 30-year option, but it acts modeled like a 3-year option. And you're getting the extra yield because you're selling this call option, this theoretical call option, for a very fancy number, a very high premium. And this call option is worth so much more now because implied volatility is high. So you look at the MOVE index, it's still well above its long-term average. The MOVE index being the VIX for bonds. And the yield curve is inverted. And that requires a little more math I'm not going to go into. But those two things have elevated the value of this theoretical call option. And so you're basically creating a buy right, where synthetically you're buying a treasury and selling a call against it. Instead of doing those 2 legs by yourself, you're buying a mortgage bond that mimics that kind of risk return profile. And that's it. I think it makes sense because I'm not sure you're going to see treasuries exploding higher in price. And I'm also not sure you're going to see them crashing down either. I think you'll probably see, you get past 5%, probably pretty tough. So we're probably in a range. So doing a covered call strategy is actually is functionally a good idea. It kind of fits my view of the world. And I'm buying a cheap security. If I thought rates were going to go to 2%, mortgage bonds, bad idea, right? If rates were going to 8%, once again, mortgage bonds, bad idea, because I'm short that uncertainty of maturity. If I think rates are going to stay between 3 and 5, great trade.
Do you think rates will stay between 3 and 5?
Yeah, I do.
Okay. So this kind of fits into like your macro framework as well, this particular trade.
Yep. I mean, my macro view is, and I won't even call it my macro view. I'll call it just, I'm old, lost most of my hair, kind of seen, a few rodeos going around. And what do I know? I know that the Fed wants a 2% inflation. Let's call that 2. Usually they want a real return, a Fed funds rate of 0.5% over. So that's 2.5. And lo and behold, you look at the Fed's long-term forecast in the dots, they've said 2.6 is their long-term number where they want, they think the rates are going to be, 2026, 27, 28. The usual spread of the Fed funds rate to the 2-year rate, 0.5 point. Okay, well now with 3. The usual spread to the 2-year to the 10-year is 100 basis points, 1%. That's 4. Where are we at right now? We're at 4. I mean, everything's kind of the 10-year is basically the fulcrum. I think what you're going to see is the Fed will cut rates. They will cut rates. They'll cut them slower than the market thinks. And we're going to rotate around that 10-year point at 4. And you're going to see the 2-year rate come down, not as fast as the market's predicting, but still come down. And you're going to see the 30-year rate actually go up a little bit. And that's going to go and take these mortgage bonds actually up in price because mortgage bonds, they have a curve sensitivity to them. And once again, you can go to my website, read some of my past commentaries where I go through the actual math and why this works. And I'll just say to you, if we rotate around the 10-year point, you're going to go and see mortgage bonds go up in price while 10-year prices stay unchanged.
Got it. Well, Harley, you are the Convexity Maven, and I've seen you write about this, that everything revolves around convexity. But it isn't always the most intuitive for folks to understand. So as the Convexity Maven, can you help us understand convexity and why it matters?
Convexity is not a natural, comfortable idea because you're basically working on, I don't want to say multidimensional, but you're working at different speeds for different things. And it's not intuitive and it's uncomfortable and challenging to understand. In the simplest way to understand is this. If you have an outcome, a bet, something where it's a coin flip, and usually with a coin flip, you make $1, lose $1. It's even on both sides. If you have a situation for this coin flip where you make $2 and lose only $1, that's positive convexity. It's a non-linear payoff profile where you make more than you lose. Negative convexity would be you lose 3, you make 2. You lose more than you make for equal outcomes. What we do in bond land, and where we hired all these physics PhDs in the 90s, is to say, okay, if a bet makes 4%, call it the 10-year treasury, it has convexity, we'll ignore that for now, pays out, it costs 4%, yields 4%. If I had another similar investment that made 2 and lost 1, well, if they both were at 4%, I clearly buy the one that's up 2, lose 1, wouldn't I? So I got to go and adjust the price. I adjust the price by making the yield lower. Now, should that yield be 375, 350, 3.25? I don't know. I just know one thing. I know it's lower. I know it's lower to go and make it, so I'm indifferent between getting 4% on a 1-for-1 bet or 3.5% for up 2, lose 1. Similarly, if I have a bet that's lose 3, make 2, I would never buy that at 4%. It's got to be higher. It's got to be 4.25, 4.5, 5, somewhere there. What the bond geeks did is use models to game out the theoretical, break even of where all those different bets should pay off. So the negatively convex bets had a higher yield and the positive convex ones had a lower yield. What I'm saying right now is when you do all the bond math on this thing, a mortgage bond being 100 basis points more than a corporate bond or 150 more than a treasury is the wrong price. It should be much lower than that. It's not for various reasons. It doesn't really matter. Who cares why it's there? I'm just saying it's the wrong number, and you'll probably earn a better risk-adjusted return by owning these mortgage bonds because they're just theoretically and functionally too high of a yield versus other assets out there. So that's convexity. Options are pure convexity, right? You pay $1 and you can make infinite or you can lose money. I'm going to look at NVIDIA options to demonstrate you can play this thing. We're recording it, a few hours before
We'll play it after. It'll be after the NVIDIA earnings. So
well, if you go look at the NVIDIA options trading right now, your eyes will pop out of your head because the options trading at very, very expensive prices. People try to figure out what's this event, what's this risk worth? Is it too high or too low? I'm not sure. It's hard to predict any company's single earnings, but I mean, we kind of know. We kind of know how homeowners are going to react and how fast they will refinance when we have millions and millions of homes. I'm not doing one homeowner. I'm doing millions of homeowners. We kind of know how they react when the economy changes, when inflation changes, when rates change, when home prices change. We kind of know how they'll react. Therefore, we can model that up after 30, 40, 50 years of experience.
And that would be beneficial to the trade, right? Like when they refinance?
No, actually, that is how you lose money in this trade.
Good to know then.
When you buy your mortgage bond at, let's say 5% right now, if rates go to 8, homeowners are not going to refinance, are they?
Yeah, no way.
You have a 5% loan, rates are 8, they're staying there. So you're going to have a 5% yield for 30 years. You'd like to get the new 8% rate if you're an investor, but you can't because your money's tied up there. If rates go to 2%, you're going to get your 5% yield for maybe a year for everyone refinances. So the investment you made is going to be gone. You get your cash back, have to reinvest it at 2%. So you lose both ways. Rates go up, you're stuck in them for longer. Rates go down, you're cashed out shorter. That's why guys are buying long-term bonds right now. They're trying to lock in a 4% yield. Are they right? I don't think so. But that's their logic, is to lock in a rate that cannot be refinanced, cannot be taken away. That's why people are buying these long-dated securities right now.
Got it. Well, Harley, it's been so great having you back on. I want to give you the last 60 seconds here to let folks know where they can read more of your work. Anything you want to plug for the folks who are watching and listening, and any parting thoughts? The floor is yours.
Well, thank you. I'm managing partner of Simplify Asset Management. And what we do is very clever. It's so clever, it got me out of retirement. We take a change in the rules. The SEC a few years ago allowed people to put derivatives, futures, options, full return swaps, all these professional instruments into ETFs. We're basically a leader in putting derivatives into ETFs. Now, that is scary. Say the word derivatives, Warren Buffett called them, financial mass destruction devices, despite the fact he's a huge user of derivatives. We basically take these derivatives, put them into ETFs, and it allows civilians, non-professionals, to get access to these professional products. And for a variety of reasons, this allows investors to very often get a better yield, a better return profile for the same risk. And that's what we do. And we've gone from 0 to $3.5 billion in short order. We have a number of very clever products that can suit your needs. We're not going to tell you what risk to take. We're just going to give you a better way to do it. Okay, you're driving the car. We're just going to give you a better car to drive. And so you should look at what we offer out there. They're pretty clever and worthwhile.
Yeah. Well, Harley Bassman, thank you so much for being so generous with your time, your ideas, and great to see you again. Really appreciate you coming on.
Thank you very much. Have a good day.